So if you can put that on paper and let other people contribute to helping you craft that message so it's easier for the audience to understand it, I think that's a really important first step.
Hello, everyone, and welcome to another episode of Test, Optimize, and Scale. It is a privilege to have Woodie Neiss here with us on the pod today. Woodie's going to talk about Title III of the Jobs Act, investment crowdfunding, the creation of it, physically taking the bill to the White House, some of the discussions around it in early stages of the industry. Don't want to take too much from his story, but as a marketer who works in this space, it's been something I've been looking forward to. Woodie, thanks for taking the time to have a discussion on the podcast here today.
Yeah, Jason, I am excited to be here. Let's do this.
Awesome. And for those listeners, viewers who are not in direct connection with you or not familiar with you yet, could we start with your background, your story, and what got you into this world of regulated investment crowdfunding?
Okay. So I started my career after getting my MBA on Wall Street, like many people that studied finance and business school, thinking that was where they wanted to be, and learned very quickly that the trading floor was not my future. I immediately went over to Silicon Valley and worked for a Silicon Valley startup at the time called PeopleSoft. They grew into quite a large corporation that was acquired by Oracle. I learned a lot about databases and used my MBA skills there to talk to a lot of CFOs. I left that to start my own healthcare technology company called FLAVORx. We flavored medicines for children so they're more compliant. We were a 3-time Inc. 500 company. We were cash flow positive. We won E&Y's Entrepreneur of the Year award. It made it very easy for me to go out and raise money from venture capitalists because we were cash flow positive and we were hyper growth. We were on the Today Show. So we had a lot of people vying for our business as opposed to a lot of entrepreneurs that are out there talking to the VCs. But during that whole time, I thought, why don't I just convert my customers into investors? And that's when I learned about accredited investors, only being able to invest in businesses. And I always thought it was a missed opportunity. When we sold FLAVORx in 2007, I spent a year backpacking around the world, did a lot of time thinking about, what I wanted to do next. Came back and said to 2 of my friends from Silicon Valley, we really need to update these securities laws to the internet age. And I had testified in front of Congress once because we sold FLAVORx because of Sarbanes-Oxley, and I testified at a hearing that Congress did not understand the impact that SOX was having on small businesses. They did carve out an exemption 18 months after my testimony, so I figured, hey, listen, I was successful once before. Let's give it a shot again. So Jason Best and Zach Cassidy-Dorian and I sat down with a blank piece of paper and we crafted an 8-bullet-point framework about what another exemption to the securities laws would look like. And we took, the principles of Reg D and what, you have to do in terms of disclosures there, which aren't much. But we added in what we thought were proper investor protections. Caps and limits on what investors could risk, caps on how much issuers could raise, disclosure requirements. And we sort of put that framework together, and then we went to the SEC, presented it to them. I was living in DC at the time, so it was super easy. Mm-hmm. They said it was cute, and they said the building with the white dome over there is where we should focus our attention. And naively enough, we just walked over there, and this is where, our lawyers would tell you that we were unencumbered with knowledge. And we just started walking the halls of Congress and knocking on the doors and asking to speak to people who are in charge of jobs. We were able to get to talk to many a staffer. We didn't speak to any senators or congressmen because we didn't have checks. But the staffers all took our meetings and they were fascinated with what we were doing. The McHenry, Representative McHenry, really took a liking to what we were doing after I spoke to Darrell Issa, who was heading up the Financial Services Committee at the time. And so we started working on the framework for this, and then he called a hearing. I testified at that hearing. The White House had someone at that hearing. The White House called shortly after that and said they were on board. I gave them a 2-page write-up. Obama came out with his statement of administrative support for what we were doing, which is like the highest praise you can get from the White House for something that's in front of Congress. We then did all the lobbying in the House. It passed the House 407-17. It went over to the Senate. There were 3 competing bills in the Senate with Senator Brown, Merkley, and Bennett. And we took those 3 bills, we merged the best of them, the best of it together. That was the final version of regulation crowdfunding that ended up in the Jobs Act. It was a pretty cool day when we were called and asked to come to the White House to meet the president and be there for the bill signing ceremony for the work that we did in helping create regulation crowdfunding. After that, I was interviewed on Bloomberg Television about what this meant for the future of startups. And after that that interview, they asked me what role we were going to play in the industry, and we thought we were going to do a funding portal. We decided against that, and they said, "Well, you've got this interesting experience in Wall Street and Silicon Valley. You know all about databases. Why don't you build a database on all of these companies raising money online, and gets big enough, we'll actually import that data into Bloomberg, because it'll be of use to many of them." Investor and Wall Street and financial service firms. So I ended up doing that and building that database that launched the day that the industry went live. And we've been tracking every single offering that's been taking place through regulation crowdfunding, and now we're at $2.5 billion later, and 7,500 or 7,700 companies, 8,700 offerings. Women and minorities are some of the biggest beneficiaries. It's pretty wild when you look at this idea that we had and how it's benefiting people all across the country now.
Amazing. So you sold FLAVORx, start backpacking, and decide, hey, I found where I want to focus next. Securities law. Let's bring it up to the internet age. Connected with Jason and Zach, built the framework, took it through all the necessary channels. Did that process take longer than anticipated? I likely more difficult than expected. Can you speak to what that journey consisted of?
It's a great question. It reminds me of a story here. So Jason, Zach, and I were walking the halls of Congress, and you get familiar with the faces that are there that are not the staffers. And those are the lobbyists. And there were a few lobbyists that we saw that didn't recognize who we were. And there was 2 in particular that came up to us and said, we see you guys going into these offices. What are you doing? Who are you with? And we're like, well, we're just entrepreneurs. We're trying to update the securities laws and create a new exemption. And they're like, well, you can't do that on your own. You have to hire one of us. And we're like, what do you mean? We're doing pretty good on our own. They're like, nope. You need a lobby firm. It's going to take $5 to $10 million, at least 5 to 10 years. You'll need probably more than that. And we're like, well, we don't have that much time. We definitely don't have any money backing us. They're like, wait, you have no money? We don't want to talk to you. And so we just ignored all the lobbyists because we had nothing in common with them. And we continued to do our own thing. But from idea to sitting in the White House was 465 days.
Wow.
And even President Obama, when he gave his speech, said this is the fastest piece of legislation to go through Congress pretty much in history.
Why is it called the Jobs Act?
Yeah, well, that's the way Washington works. Everything's an acronym. You have to have an acronym that America will understand. So you don't want to call it, crowdfunding because, that's confusing. Like, what is crowdfunding? At the time, nobody knows what it is. Even now, very few people understand what it is, and they get confused between donation rewards, debt, and equity. So
I explain it every day.
The Jobs Act really came down to the provisions of the Jobs Act itself were about capital formation, but at the end of the day, capital formation leads to job creation. So the Jobs Act really stands for Jumpstart Our Business Startups Act, leading to jobs. So it sounds like jobs, but it's really about startups. And
I imagine timing had a big, role in this. The 465 days, dramatically less than the 5 to 10 years, 5 to 10 million, by the way. It sounds like, Jumpstart Our Business Startups Act it fit very much into the initiatives back then. Is it playing out the way you, Jason, and Zach had envisioned? You created this. We're here in 2024. What can you say about the shape it's taken since May 2016 when Title III physically went into effect?
Yeah, when this started, I really thought it was going to benefit two different constituencies. I thought your Main Street sort of small businesses that are not getting funded by banks, and we're back in that phase again, that area where banks are not lending to small businesses. So I thought they'd be able to go online to their customers and borrow money from them. So I thought the debt side of crowdfunding would really be a huge opportunity. And then on the equity side, my thought was, well, it'll probably benefit a lot of these software technology companies that are in the space, that have a great idea, that are coming out of universities all across the country or in places like Denver, where I live, and not close to Silicon Valley, but have strong communities and strong networks and can leverage that to raise some small capital. I then am blown away with where we are today. It's happening in 1,700 cities. We track NAICS code as one of the fields within our database, and NAICS code is the industry classification sort of system. I think there's over 520 different NAICS codes that have been funded. So to see the broad application of this across industries proves that it's not necessarily about software, but it's about your, whatever you're doing. If you can get a story across to people, you got a great team, a smart valuation. That's another conversation we could have. But you've done something before and you're going to try and do it again. We see stories like that happening all the time in this now, and I think that's a great thing that came out of it. I'm still surprised, and I think we're starting to see the seeds of it changing right now on the debt crowdfunding side. The whole peer-to-peer lending opportunity that we heard about, what was that, 7-10 years ago now, is, I think, starting to happen in the debt crowdfunding side. So the P2B, the people to business lending. And we're starting to see more of those offerings take place, but I see that starting to pick up. I would have expected it to be bigger than it is right now, but I did not expect to see the equity side to be as fast growing as it's taking place right now.
Sure. And like you were saying with the NAICS code and how many industries, I'm asked daily, what verticals does this work for? It's just for tech hardware, right? I don't have a flying car. I don't know if it's going to work for my business, but I'm able to point to success stories and the data you guys put out, other data that's available on those 8,700 offers, 7,700 issuers that have put those out to be able to show, at least in my perspective, it's more about how they market. It's more about how they storytell. It's more about how they get awareness and use third parties to validate the deal. I found it to be, very much a digital marketing exercise, even looking at it as, an e-commerce campaign of stock, following the rules, following compliance, of course, but to get user owners in many cases, and I've written articles on that, as well as historical, at this point, equity crowdfunding investors that are regularly adding to their portfolio. But like you mentioned, I'm explaining to people what equity crowdfunding is every day and have been doing so for years as part of my discussions. I would have imagined perhaps more government incentives, more awareness from accelerators and other types of, entrepreneur focused, let's say, media publishers and support systems. With the amount of companies that incorporate every year, I'd love to watch more of those founders utilize these vehicles. And although 2.5 billion is huge, I think it's very exciting to picture where this can be 5-10 years from now.
Oh yeah, we're at the cusp of something that'll be much, much bigger later on.
Mm-hmm.
To go back to what I was talking about with the whole P2P lending.
Yes, debt.
So with Cabbage and Lending Club, that whole industry popped when institutional capital came in. We don't have institutional capital in investment crowdfunding yet. We've got phenomenal verticals, like you can invest in a racehorse. People are putting solar panels in communities, and you can invest in bunches of solar panels that are going up with a dividend that's predetermined. it's the whole spectrum is there, but it hasn't popped because we don't have the institutional capital. And that's where we're really thinking right now is how do we get institutional capital in the space? And, we took the data. We sat down with three data science PhDs and we built an algorithm.
Mm-hmm.
And we said, the data, if you look at the entire data set, can tell you a bunch of things. We can look at success versus failure. We can look at capital commitments over time to follow trends. That also tells us about investor sentiment. It tells us about issuer sentiment, tells us what's getting hotter, what's getting colder. And we can, with all of this, you can look at the signals that come out of it. And if you can compare the signals to companies that are coming in the data set, you can look for matching signals in an algorithm. And so we built this algorithm to look at all the offerings that are active on a daily basis. And right now there's 530 active offerings on a daily basis as of today. And the algorithm tells us which of these companies we should be looking at to diligence. And so on a weekly basis, we have an investment committee that sits down and we look at these deals and we do what the algorithm can't do. We do human diligence on them, which is what VCs do. We talk about the team, we talk about the total addressable market. What kind of patents do they have to protect their IP? Where are they on their revenue journey? And then we make an investment decision. And we're doing that through our venture fund, D3VC, because in our brains, we're thinking, if we can prove that if you have a diversified investment basket here, and you'll have many outliers, we think if we target these signals correctly from the algorithm, then we can prove to institutional capital that while you can't diligence thousands of deals or hundreds of deals because they're too small, our algorithm can do a lot of the heavy lifting, and you can invest in venture funds that actually do the investment for you. And they, a lot of these financial service firms have got mandates to invest in women and minorities or small businesses, and they don't know how to do it. This might be the pathway that can facilitate that for them.
Mm-hmm. Women, minorities, small businesses, the numbers are outstanding in comparison to historical figures in terms of access to capital, and on the other side of the table, access to early stage, growth stage deals. You were talking about valuation a bit, but getting in and being able to play the game of private equity, which historically was reserved for the few versus democratized for everyone.
Right.
I think that's really something that's profound about the vehicle that you created.
Yeah, just to talk about the women and minority opportunity for a second, we track in each of these offerings if there's a women or minority founder or co-founder. And we tag them. We have many different tags. We have tags are VCs, tags are accelerators. We want to follow Shark Tank issuers to see how they're performing versus other ones.
Mm-hmm.
But with the women and minorities, if you look at just what traditional venture capital is able to do on an annual basis, they fund about 2% of women and minority founders that come through their doors. If you look at the number of women and minority founders within investment crowdfunding that are successful, it's up to 40% a month that have a women or minority founder. So this has really democratized access to capital to these groups that are shunned by Silicon Valley. They might be putting lip service to the fact that they want to invest in more. And yes, they can write much bigger checks and deploy much more capital. But I think we're sort of proving that, we're at $2.5 billion right now. When we're at $100 billion, we're going to be deploying much more capital than Silicon Valley is into any women or minority founders.
You get me excited talking about this. I mention the future and on panels and podcasts and to issuers, but hearing you speak about it and towards past statements that have come to life, it's very enrolling to hear where the vertical's going.
Mm-hmm. Yeah, not that there's not drawbacks to this entire industry too. You mentioned the valuation thing.
Yes.
We have to talk about that. Valuations have been skewed. They first got skewed by VCs who had a lot of cash on hand 5 years ago and were just throwing their money everywhere. And so entrepreneurs realize I can just have a higher price tag for my round because VCs just have a lot of capital to deploy. So our industry is not responsible for the high valuations. We're just living through the after effects of what happened. So there's a lot of down rounds that are happening now, but we track these companies through their incorporation date. We track these companies through their revenue. So we look at companies that are startups, which we tag as under 3 years old, or established, which is over 3 years old. By the way, that 3-year break is where you can go to a bank and say, I'd like to apply for a loan. If you're under 3 years old, it's pretty much impossible. Banks just won't lend to companies that are less than 3 years old. But if you're over, then you can talk to them about getting a loan. So that's where we came up with that sort of 3-year break. And then pre versus post revenue. So when you look at those different buckets, those 4 different categories, you can see what's really happening in the whole valuation sphere. In your pre-revenue startup category, we're seeing valuations, the median valuations start to come back to that 5 million level, which is where you sort of expect them to be for a company that hasn't proven itself. It changes as companies generate revenue, as they grow, and the median valuations are moving up. Where we've seen the median valuations continue to increase, which people say is bad for our industry, but I don't think so, is in the post-revenue established quadrant. And in that quadrant, what we're seeing, and you really have to dig into the data, you really have to understand what's happening in the industry, is there's a shift that's taken place in this entire industry where when it launched, it was all pre-revenue startups. So the majority were pre-revenue startups, 65% of the companies. Now, 65% of companies coming into the space are post-revenue established. So they're less risky, they're bigger, they've proven themselves, they've got more revenue. They demand higher valuations by default, just because of where they are. And their valuations continue to go up. We're also seeing in that category a lot of venture capital backed startups. So VC-backed startups, they've already done diligence on these companies. They've already put their money where their mouth is. So there's already a higher valuation point for those companies. So we see that happening in this sphere. But at the end of the day, if you are an issuer that's looking to invest in this, you really have to sort of figure out what is the right valuation for your company. And we've talked to a lot of issuers about, looking at all the data set, comparing you to other companies within your industry so that you can come up with a justifiable valuation. And we find that when issuers spend that time to do that, when the questions come up, how do you defend your valuation? You can just sort of spit out the comps related to it, and it helps justify why you are where you are in your valuation right now.
Absolutely. And you shouldn't be too opportunistic in the valuation because of the fact that everyone's operating on the same terms. I mean, there's still the larger strategy to fit into, and the benefits of having everyone operate on the same terms and not get that valuation slashed just for sake of negotiation from the other side is huge. At least that's what I hear from founders. I try to base it on, because I'm in the marketing lane, I'm in the marketing seat. I try to base it on what our clients are telling us, and they're still listing, many different items that are more favorable for them for this vehicle. Let me ask you, because I'm generally introduced to groups once they've already, filed a Form C or 1A, what have you. Perhaps already live on a portal, and I know many of the portals are being firm about who they're accepting. You were mentioning post revenue. I've seen a lot more rules around that. Do you think this is an avenue that most groups, all groups that are fundraising should be going down? What data points, what issuer sentiments are you seeing to suggest which groups may be a better fit? If not, I am from the school of, if you're doing a Reg CF, you should absolutely be marketing, P2P on the debt side, equity, and I shout out traffic algorithms and how many visits they need to get how many investors based on average check size to produce their goal. And I feel there's some misconceptions in this space that not everyone's aware of there. But which groups would you, here in 2024, encourage to use Reg CF, and which, if any, would you not?
Yeah, it's another really great question. At the end of the day, you have to look and see what your Rolodex consists of and who's willing to write you a check.
Okay.
If you've got access to venture capital, they've funded you before, and you can just walk in the door and present your business plan and tell them what you want to do and get a check from them. That's essentially where you focus your attention. Unfortunately, for the other 99%, that's just not an option.
Yeah.
And so then you really just need to look and see, well, what can I do with my connections? If you've got a lot of accredited investors in your network where you can raise capital from them, focus your attention there. 506c type of offering would be great for you. Most entrepreneurs just don't have that connectivity to rich people. They are starting businesses. They've got an engaged community that believe in them. For the women and minorities, a lot of the people that back them are women and minorities, so they look like them. And so what's great about investment crowdfunding is it allows you to look at your community and just raise money from the people that are closest to you. So if you've got access to the capital, go for where that is. I also tell people that this is like getting on a highway, but instead of you being in one car, you actually own 5 cars and they're in 5 different lanes on the highway and they're going at different speeds, because you shouldn't put all your eggs in one basket. If you should have communications going with whomever you can communicate with, because your goal at the end of the day is to raise money.
Yes.
And you need to be focused on whatever avenues you can raise that money in, and not sort of pigeonhole yourself into one opportunity, because that might not be a good opportunity for you. I mean, there's plenty of cases where investment crowdfunding doesn't even work for some of these people. We could talk forever about why. I'm sure just as much as I do in terms of why a lot of these offerings fail. But at the end of the day, a lot of what happens in Silicon Valley just doesn't apply to the people that are looking for capital. And what you and I are doing in terms of this podcast and spreading awareness is trying to get more people engaged with. There is a new mechanism. There is a new way. It is being used successfully. And this might apply to you. Just a little research on your end, and you could benefit greatly.
Wow. I am going to be quoting you and repeating the highway, the 5 cars. I say many similar things. If you can get this offline, if you have the network where you could do a 506c and solicit to accredited investors in your network and bring them in to substantiate your round, fantastic, because these are a lot of work. I find the top 10% of campaigns move. The bottom 50% are stagnant. And I'll look at the full number of the 8,700 offerings and categorize, and I'm taking notes from you, and I see your databasing, history. I've got a full page already here, trying to keep up with you. I feel like I could keep you on for hours and ask these questions. But to be able to say, hey, side by side, Reg D, Reg CF at the same time, or Reg CF for these conversations, do whatever you can to hit that goal, hit that, raise the capital compliantly, make sure everything's approved by legal, of course. But it's a time clock, and you need to be able to hit it within your filing dates.
Oh yeah. And these, I think the difference between Reg CF and like your typical 506B type of offering as well is your offering can go stale in a Reg CF arena. You got this short window to really get things done. And I see that these offerings really last about, 90 days, I would say the median. So it's not like your typical, Reg D offering where you're out there just talking to people over the course of a year or two and constantly raising money. I mean, you have to be very focused. You have to have a whole marketing effort put together on outreach.
Oh, yeah.
That should better be done before your campaign launches. So that what's going out each week, what you're announcing, what you're excited about, updates. All of those updates make a big difference, because people aren't just looking at your offering page for what happened in the past. They're looking at the bottom to see what updates do you have that are current that would want to make me look at this deal or invest in this deal. And then the other thing, which nobody really seems to talk about, is the Q&A, the comments. People really need to, like, if you're an investor and you're thinking about something, get a sense for what they're doing. But I would jump right down to the comments right after that and start reading what other people are thinking and asking. The only reason being is there's a ton of smart people out there that are investing in these deals. And they have a lot more knowledge and experience probably in a vertical than you and I do. Like, I know nothing about biotech, but I see plenty of biotech deals. And on those deals, when I look at the comments, I see other people that are in biotech saying, when we look at your technology or your IP, I have a question about this. And then look at the answer. You want to see that people are forthcoming in the timeliness to which they're responding to questions, because if they don't respond timely, they're probably not going to respond to you later on after they take your money. So I would look at that as a negative. But you want to see, are they really able to answer the question? Like, how detailed are they in that? That instills a level of confidence when they do have a detailed answer as to why, or what's going on with that question. And I think it brings in more credibility, not only to the offering itself, but really to the industry. I mean, you don't really have that in any other form of this private capital markets. When I raised money for FLAVORx, it was done behind closed doors. It was done with one, private equity or venture capital group. And, they would ask a set of questions, and then I'd go fly across the country and sit in another boardroom, and they would ask a completely different set of questions. And I was like, well, that first group probably could have benefited from these conversations. But in investment crowdfunding, everything's mandated to happen online in one central place. People should look at that as an opportunity to learn and understand more than you probably can in many of these private offerings that are taking place offline.
Yes, and digital allows for scale. The founder, instead of talking one-to-one, can speak one-to-many. And you're looking at the frequently asked questions, the questions on the portal, on the offering page, and seeing other conversations that are occurring. We stress content marketing. And I could tell you a lot of issuers aren't as interested in content marketing because they're talking cost of capital, they're talking direct response marketing, which is crucial. It's not to be, in place of, but I could tell you that advertising, that outreach performs tremendously better with momentum that's being showcased across social media, email. If we're growing their email audience, first question I'm asking an issuer is, how large is your audience? Long form content, monthly webinars. The first one could be, a pitch presentation. The next, a town hall. You could have everything living right there on the portal, including the promotions leading up to it. We encourage articles every other week, even if one's just the webinar recap, and the other, we have an interview process where we can, capture voice, capture expertise, and distribute accordingly with approvals, weekly updates, if not more. I know some of the portals say, hey, 2 to 3 updates per week. That takes a lot of planning. That takes strategy. Whole nother conversation of groups that hesitate towards investing, let's just say, time into strategy, but determining, hey, where is the conversation going? This digital funnel that we're creating, taking audiences from awareness to consideration to intent to investment. I find, on some of these Reg CFs, 10 to 30% of investors are participating multiple times. How do we get repeat conversion? And most importantly, advocacy. That's what you really want to see come out of the content marketing. I mean, statistically, we're going to have a better conversion rate if all of the things that you mentioned are living in, a content funnel. And then if it's working, you mentioned 3 months. I want to add to that, saying that I point at 3 months as best practices for marketing and wouldn't do any less. We will if we're requested, but meaning if it was my company, if I was the founder, and I say this to anyone we take on lower periods of time for, I would definitely give more time to optimize. It's going to produce a better result as a rule of thumb. But if it's working from there, definitely lean into it, definitely scale. And I say that because if based on stats I've looked at, using round figures, if the top 10% are producing 750K or more, the bottom 90% less than that, if it's working, even at a small return or at a small, at a slow pace, a longer window of time could benefit. Also, I see the top issuers come back to us and say, hey, let's do another round. We're on our 4th round with a group that just went from test the waters to a live Regulation A+ campaign, past 36 hours, almost 48.
Right.
And they while we're talking, should pass the $2 million mark. They've done 3 Reg CFs before that have been multiple 7 figures. There's sayings in the industry such as always be raising. So I can say that time in the market can help, but there has to be that storyline. There has to be that content calendar, what's going to be distributed when and where, and groups that are just posting it's absolutely going to go stale after a few months.
Now, let me ask you a question on that, because,
Sure.
I can see how a lot of people would get worried or how do I even tackle this?
Yeah.
Like I tell people all the time, and I would love to hear your thoughts on it, is keep your messages short and simple. Do a lot of updates that are short and simple. We live in this attention deficit disorder society. Nobody's going to, read much of anything. We have messages coming at us left and right. Are you telling people, when you're doing this content creation, let's focus on, one key thing we want to get across, or, what are you telling people how they should, create this content?
Don't say anything in 3 paragraphs that could be said in 3 words. I've done exercises with clients following the 3-1-3 method. Ryan Folan created it. I should give him credit. And he was my first podcast guest. You break down what you do into 3 sentences, then into 1 sentence, and into 3 words. It's difficult to do. I'm making it sound quick. It's that same mentality that I like to encourage my team to use when writing, when crafting copy. Now, we can tell a story. We can cover many moving pieces throughout the course of a content calendar. And I find if an investor is searching around, doing their due diligence, some people like to believe retail investors don't, but they absolutely do. In some cases, I think even more so. If they get to a social media feed and nothing's there, it says something. If they get there and there's a few posts, but nothing about the raise, okay, why are they keeping this private? This is, public format. If you get there and, there's 3 posts or more a week and referring back to the raise, talking about the problem, the solution, the team, the opportunity, all the things you'd read in a, pitch deck, all the things that you'd read on the offering page, following compliance, I think it says something much louder and, in a positive way. And you could then use these brief statements. If I look at a social advertisement, and really that's where the traffic comes from social media, minus, social sharing and, perhaps a viral type of event, but social advertising is very consistent. It shows a high click-through rate, high conversion rate in comparison to other advertising channels. You get a line of copy above the image or video, a headline below the image or video. Some of the ad placements and newsfeed link description will display itself. You have to engage the audience to a strong enough degree with that brief little glance to get them to click and get to the offering page. Talking about the offering page, it has to then pass the glance test in the sense that I want to be able to read through that page 10 seconds maybe on my mobile device. That means I'm reading headlines. That means I'm glancing. And then I'll tell myself, hey, I want to go back and read more about this aspect of the model. But if it doesn't pass the glance test, I'm gone. I'm trying to, filter out all these other promotions, like you said. I heard a stat where, we see 60,000 ads a day. Now that would include every, little logo around us and everything that we're bombarded with, work, social pages, so on and so forth. But yes, you will lose them if you take too long to grab them. And you could pull them in with the bolded headline, larger text, more appealing typography to then come back and read more later.
Yeah. Yeah. Well, gonna hire you.
Woody, I've seen so many of these campaigns, over 400, probably over 500 at this point, that we've worked on directly and have talked to thousands, that it helps to be able to show the numbers, the statistics, the measurements. That's why I'm such a big fan of what you do now, as well as what you've accomplished to date, which, it's beyond notable for me. It's, again, really privileged to be able to speak to you about this. And if I'm able to show these stats, it's no longer just my opinion when I'm speaking to a prospective issuer. They'll take it more seriously. And I want to do whatever I can to see a higher success rate industry-wide. So like you mentioned, that's why we create this content. That's why we look to get these recommendations out there. Speaking of which, what would you recommend for issuers to test out towards their own success? I say test not to be non-committal, but because I look at marketing. I look at these tactics as a series of tests and optimizing towards what works. What would you encourage them to do? This could be in the planning process, the filing, bringing in that first network, the marketing itself, the closing. You could take it anywhere you'd like, but what tests would you encourage listeners to take advantage of?
I mean, I think there's a couple things. I think the first thing that you need to do, to your point of you need to make sure that you capture their attention, is when you're putting your offering together, you've got this offering page, okay, where you actually do your marketing. Write some copy down and share that with the people closest to you. Does it make sense? Does it answer what we're doing? Do you understand the problem that we're solving? You want to make sure that other people, and definitely let them rephrase it for you. Let them, because the problem that we have is we're so ingrained and entrenched in thinking about something that we know a lot about, which makes us an expert, all of us experts in something that we're doing. But it's very different from someone else's perspective in terms of understanding what you're doing. So if you can put that on paper and let other people contribute to helping you craft that message so it's easier for the audience to understand it, I think that's a really important first step. Second is you need to have certain things in order. First and foremost that we talked about is your valuation. So you need to spend some really credible time thinking about what is the right valuation for this company. If you've got a valuation that is out of whack with your revenues, if investors are smart, they're just going to pass on the deal. We saw one, it was a beverage company. They had a $113 million valuation and they had $1 million in revenue. You tell me how you come up with that revenue. It makes no, to me, when I see something like that, I was like, sell the company right now for $113 million and run off with the cash. But no one's going to pay you $113 million on $1 million in revenue. So be smart about it. Also, strategically, you have to realize that you have to give investors room to grow with you. If you come in with $113 million valuation, where are you going from there? It's not like, you can get to 250 million pretty quickly unless your revenues really jump up there. So you have to be, investors are going to be looking and asking, is there revenue growth or valuation growth in what they've done there? So really strategically look at that. Also, I think another thing that people don't really get across clearly is, why do I need this cash? Like, what do I really need it for? What am I going to do with it? And and this is a key part, what am I going to achieve with this cash when I get it? And I say that's a critical part because raising money is not once and done. It is and you mentioned it earlier, it's a cycle. You do it over and over and over again. If you are setting milestones in your offering and telling people what you want to do with that cash, then in your subsequent round, and you can show people, listen, just go back to here, you can do a hyperlink. I told you this is what we needed the money for. These are the milestones I wanted to achieve. And then you can be like, and we hit them, we exceeded them, we didn't hit them, and this is why we didn't. I want to be really transparent about that. You're building credibility, you're winning over investors, and you're more likely to get them on board. If you try and hide anything, someone might uncover it for you anyway, and that'll derail your whole offering. The problem with these online offerings is it's online. Yep. So it's very easy for people to do research on it, and it's very easy for them to add questions in there and question the credibility of things. You don't want that to happen in your offering. So spend time really thinking about, what you need that money for, and putting those milestones together, because I think that'll help you in a follow-on round.
And I learned offline in early ventures I was a part of, it's very difficult to go back to the same investors for the same use of proceeds in a future round. You want to be able to show that success exactly as you're saying. So be realistic with the valuation and what you're putting together. What about if it's not working right out of the gate? You have the optimization to a level you think is good. You're getting positive responses on the copy from the individuals that you're speaking to offline, but you're not producing the results that you need. What are the best approaches towards optimization in your eyes?
I mean, I think at that point, and you probably know much better than I do at this, but I would say you need to go back to the people that are closest to you to make sure that if they expressed interest in being a part of it, that they are on board and they're invested. And if not, you need to find out why, and tackle that so you can get them in there. Because a lot of this, as you just pointed out, it's not that it's monkey see, monkey do, but nobody wants to be the first one on the dance floor. I'm sure you've been to many, events as a kid where, it's the music's playing and nobody's there. Well, just because everyone's shy and nobody wants to be the first one out there. The whole game with raising capital is the same thing. So you need to have that really first 30% sort of circled up, soft circled, before you go live. And I tell people to try and do that all the time, because even when you circle that 30%, you have to then turn them into cash. And you're going to encounter a lot of reasons why. This is just a bad month for me. I can't write the check. I need to buy a car. Our AC went out. There's going to be thousands of reasons why they're interested, but they can't. And you just sort of need to know if and when that is going to happen. But I'm sure there's plenty of things that you could probably tell us from a marketing perspective, or what you need to be doing to sort of pump it up. And sometimes it's just not working, and you have to understand that it's not working as well. There's a lot of ego involved in putting these offerings together, because you are essentially putting your time, your energy, everything that you've created. It's very personal to put it up on the internet, and to not see it succeed is a really hit to integrity. And I think for many entrepreneurs, you have to know when the time is right to pull it. If it's not going anywhere, I tend to think it's better to pull it sooner than later, and be like, I just needed to rework some things, and then go back later on, rather than have it go the life cycle of it and go nowhere. You'll look smarter, I think, the quicker you pull it, because you're doing it on your terms and you're maintaining that control. I don't know if there's enough people that really think about taking an offering down, but it sort of keeps the power in your own hands.
Sure. I know it's a tough decision, like you said. We'll often bring up the idea of a closing and marketing during the closing, and see more people dance on the dance floor during the last song. The fear of missing out increases. That's not to say we harp on it for groups that have seen no performance, but I find a lot are in that middle stage, and they could really see it round out well with the closing. I really like how you talked about going back to those investors that you presented the copy to, figure out if they invested, really analyze why they didn't, if not, and use those findings towards the next iterations of your tests. Because we have assumptions going into a campaign, but we need the data, we need the analytics to show us what's working. In many cases, campaigns I thought would have done great. They had sharks or the right figures attacked to it, and they underperformed, performed marginally perhaps. And then I get caught by surprise all the time from groups that I have question marks around, and I'm taking extra steps to encourage audience building. Like you said, if you get 30% in early, it sets a strong foundation for you. There's a lot to point at. So I really like the recommendations. What about scale? What have you seen, whether it was, from your history directly, or just, what you've watched in the market, in terms of scaling, in terms of success? Any examples, any tips you can provide?
There've been several that have gone viral.
Mm.
And I think it really comes down to you having that message with the core group of people that are your initial investors, to get them to reshare what you're doing. And because, raising capital, it's about raising it from your first degree network, as I see it through investment crowdfunding, at least, and then engaging that first degrees network as well. And that's that second degree. And so where it's gone viral, I feel like these people in that first degree are sharing social media posts, are sharing emails that have come out being like, listen, I invested in this company and look at this update that they have. They're already doing great things. So getting people trained on resharing and telling people, I need you to reshare this. I need you to, send this to 5 people in your network. And you can say, just because we're trying to increase awareness of the company, or you could say because we're just trying to raise more money. But success, I don't see overnight success with any of this. There's no get rich quick for anyone. And in terms of even raising capital for the offering, it just takes a lot of time, energy, effort, and thinking before it goes live.
Woodie, this has been a real treat. I want to echo everything you just said right there to the audience. If listeners, viewers want to listen to other pieces of content you've put out, if they'd like to learn more, even get in contact with you directly, what is the best way for them to do so? And what are any final thoughts you want to leave the audience with?
So we sort of sit in the intersection of what we see as 3 themes in this marketplace that's taking off. So Crowdfund Capital Advisors is right in the middle, and this is our consulting and advisory practice. But that venture fund, if people are interested in how is a venture fund able to disrupt this marketplace, they can go to d3vc.ai. The data is, as you and I both know, I love to talk about the data. I live in that data world. We're in our office here. All we do is talk about data. We have a whole division, CCLEAR, CCLEAR.ai, that has the data. And what we realize is people need to see data converted into analysis. They need to see it turned into research. And that's what CCLEAR does, is it produces a lot of research off the data so people can really understand what's happening in the industry, both on a weekly basis, a biweekly basis, a monthly basis, an annual basis. How do you use the algorithm and then produce research so that investors can look at this as, an algorithm told me I should look at this. Maybe I want to look at this, and do my own research on it. And then we've done really cool things, like we just launched this crowdfunding genome. So, when you look at what happens, Silicon Valley is the perfect genome. Like everybody's like, well, it's a startup central. Like what are they doing right? They've got the DNA for it. Now that we have, 8 years of data and thousands of companies doing thousands of offerings, we've got this data that allows us to actually look at what's happening in the entire United States and create these genomes to look at where this entrepreneurship, innovation, job creation is happening through crowdfunding. And so we created this genome report, and that's on our website, the CCA, crowdfundcapitaladvisors.com, where people can look and see the top 30 genomes across the country, why Phoenix, Arizona, and Phoenix Scottsdale is number 1 on the list. It's Silicon Valley is number 2. We could talk in a whole another podcast about that, but it just shows you how certain cities are really saying this is an opportunity for us to bring in startups, to have the community fund those startups, to have the investors here benefit from wealth creation through these startups scaling. And so that's what the genome was really trying to do. And help economic development officers that are looking at, how do I create more payroll tax in our area? What do I do to create more economic activity by having more companies come in here and buy products and services from other people in our communities? So that's the CCLEAR side. And then another area that we did not talk about, which could be a whole other conversation, is liquidity. People that are investing in these companies want to have liquidity. Typical liquidity comes with an exit, a merger, a sale, an IPO. But there is the possibility to have these securities listed on what's known as secondary exchanges or alternative trading systems. And we have a compliance technology arm of our business called Guard. And with Guard, we do ongoing reporting so that companies that want to list their securities on these ATSs can comply with state blue sky laws. And so GUARD, D3VC, D3VC, and CCA. Look everywhere.
CCLEAR. Yeah. First of all, I want to point out to listeners, viewers, that you can be getting the same data that Woodie, acts off of, is able to speak to. Thank you for creating a Reg CF, Woodie, and making this available to all of us. And, like you said, the results are going to be substantially larger, in years to date. I would encourage everyone to get in touch with Woodie or, engage with GUARD. Maybe you want to invest in the fund, CCR, CCLEAR. There's so much going on to be a part of, and take his recommendations to heart. Want to echo again, get that social sharing, get it to be a systematic part of your checkout at that, to get investors to share with people in their networks, to get, your content repurposed again and again and again. Woodie, can't tell you how much I enjoyed the conversation. Thank you so much for making the time to talk with us on the podcast here today, and look forward to finding more ways to collaborate with you in the future here, the next chapters of Reg CF.
Amen. Looking forward to it, Jason. Thank you so much.
Thanks, Woodie. Thanks again, everybody. We'll see you next time. Take care.